is brought to you by McIlvaney ICA. ICA has been America's foremost precious metals brokerage firm since 1972, helping you build a strategic precious metals portfolio. Call 800-525-9556 to buy gold, silver, platinum, or palladium today, or go to McIlvaney.com.
Welcome back to Golden Rule Radio. As we go into winter here and Christmas time, we always like to look back on the year and other years past, and that's what we're going to do a lot on this show, look at a little bit of a big picture, but we'll also look at this short term. Short term, since last week, gold's been fairly flat. It might be up $1 or so. Silver's about flat. Platinum is about flat to a little bit down. Popping back up, though, showing some signs of life. But let's start with gold.
Yeah, Robert, appreciate it. And we're actually going to blow through these charts exactly for the reasons you said. We've got a lot of flat movement, a couple things to point out, but we have a little bit deeper conversation to have because, as many of our listeners appreciate from time to time, I've got Rob Squared today, both Robert and Rob back joining us in the studio this week to talk a little bit about money supply and history on gold pricing. And we're going to get into a couple common questions that in the precious metals industry we get often, both from our listeners and our clients that we were talking about earlier. So, Rob, welcome back once again. Always
Thank you,
happy
Miles.
to have you.
Yeah, good to be here.
First of all, as Robert said, looking at gold, 1784 on the gold price here today, recording on Wednesday this week. Gold has been in this short-term climbing channel. We pointed out this higher high that it was able to put in, gold for the last year or so after taking this monstrous almost 100% rise from 2015, 2016 up until last year, 2020. We have had this 382 fib correction back to about 1680. So as you can see in the short-term chart over the last couple of months, it does look like we're starting to put in some higher lows and higher highs, and we're right at the bottom end of that rising floor channel in the short term. If we were to push up from here and put in another higher high, that would be very bullish for gold. And then obviously a breakdown below that will readdress that if that happens over the next couple weeks. So I would keep an eye on gold in the short term over the next couple days. Nobody in this room is a short-term trader, so that's not what we're looking at encouraging anybody to do in the physical metals sphere. But it is fun to watch these prices when they're right around some trading levels and see how they react. Moving over to silver, same thing. We had that higher high pop up at the beginning of November, but silver, being the more volatile metal, has taken a pretty strong move down. Still hasn't put in a lower low. That long-term floor in silver dating back to about September, October of last year hasn't been breached yet and still holds, although we're just slightly above it. So same thing, if we see gold turn up, silver would follow, but you can see silver all the way down at the 786 correction in the short term and holding over the last couple days at that price level. Platinum, similar story, put in a short-term higher high, and we might be putting in a short-term higher low. In fact, platinum has already turned up. If you saw in the gold and silver price, they both look pretty stable, but platinum is up maybe $20-30 over the last week. And if it were to continue up over the next few days, that would be very good news for platinum. All of this is on the heels of the dollar, which has been rising since this past summer, coming down sub 90 at the beginning of 2021, coming down and retouching it again, but then putting in a little bit of growth up to just shy of 97. The 50% correction line is sitting at around 95.9, going back from the old high at 103 down to that 89.90 range. And we've been parked right around this 50% line. We're back below it today, but we did have a nice drop in the dollar just today. And if the dollar were to continue down, that certainly would coincide with gold, silver, platinum prices going up. And finally, just to take a quick look at the Dow, we put in that high a little over 36,000 and a nice drop that failed to put in a lower low. So when I brought that up a couple weeks ago, we've had a bounce, but we had a gapped bounce, and gaps tend to close. And again, if we saw the Dow turn down from here, you've got quite a ways to go. And Tori brought this up, the 20% decline rule, which is one of a number of rules that kind of signals a bear market. Well, 20% down from the previous high, as you can see on this chart over the last year and a half, actually lines us up with the pre-COVID decline high, which is also the 382 fib retracement back from where we're at just shy of 30,000. So We're not a predictive show here on Golden Rule Radio, but as I've said a number of times, I like when multiple things line up at the same place. And when you've got a previous market high from about a year and a half ago lining up with a 20% decline number, which is sort of an arbitrary standard in the industry, talking about price reversals, and it's sitting right at a 382 fib. I just like when you've got a couple different angles all lining up at the same price. So not saying the Dow hit its ultimate high here recently, back in November, a little over 36,000. But if that were the case, the chart would look real pretty.
Yeah, with things lining up, you've had this big dollar rally up to almost 97, which is a multi-month high. And at the same time, you have not seen a new low in gold. Gold has put in 4 or 5 higher lows, and it's sitting here chopping around for a week or two. And I get the feeling that we may be, if gold holds in this level, it's above 1750, and it starts to move higher, we may be ready for this next big rally. And the next wave on gold is going to be explosive.
What's on the minds of our clients when they call? I've had a number of people say, how come gold is not keeping up with inflation? Why is it not doing anything? But then getting back to what you were saying earlier, Miles, what are some of the other questions we're getting? What good is gold if nobody has any money to buy it? And how am I going to barter with gold? Or the price performance of gold is lackluster. What happens if the government goes to using Bitcoin as currency? You know, these are the kinds of questions that we are getting. But getting back to one of the major questions I'm hearing is the lack of performance of gold, especially over the last 5-10 years. And it's true. If we go back 10 years ago, the Dow Jones Industrial Average is up over 140%. Gold's just up 9%. But it depends on where you start the clock. If we go back 20 years, gold's up over 552%, and the Dow's up 267%. So is gold a measure of value based upon its price action, or is it just capital that moves us through? And my point is, in looking at the chart of gold versus the M2 money supply, if we go back to 2011, you can see the spike in the value of gold way above M2 money supply, just like it did in 1979 and 1980. Where we are now with gold versus the money supply, it's just like it was in 1973 when I was a high school sophomore buying gold at $100 an ounce, or like it was in 96 with gold at $250 an ounce. We are at that level versus the money supply. And the question becomes, when do you want to buy gold? Do you want to buy gold when it's way above this M2 money supply growth, or do you want to buy it when it's at par with M2 money supply? Basis this 50-year chart, Miles, that you did for me, and I appreciate that. So as we look forward, I think there's a lot of speculation. Is the Dow going to drop 20%? We don't know. It could very easily. But we do know that gold will keep up with the growth in money supply, because that's what everybody's worried about. And I would reference also Shadow Stats. They went back and recalculated inflation back to the same formula that was used under Jimmy Carter. We are now looking at inflation over 14% annualized. Now, I know the government came out with their inflation statistics, something like 6.7%.
Yeah, if you remove everything that people actually spend money on from the inflation statistic, it looks pretty good.
They did. They removed food and energy to come up with that 6.7% inflation rate, which is ridiculous.
Yeah, you'd be a fool to trust the government statistics. Really, sorry, you just would be.
Well,
it's proven over and over again. It's lie.
Why do people buy gold? Are they buying gold to get rich? I constantly remind people, look, people buy gold because they're losing faith in the system. That's the bottom line. I mean, they're either losing faith in the currency, the markets, the government, whatever it is. But I try to encourage people when they ask me, well, how am I going to barter with this? I'm like, okay, you have a very narrow view of what gold and silver is actually for. Yes, you can barter. I think that's a very low probability event. If we get there, we are talking a Mad Max zombie apocalypse type of scenario. But in the meantime, gold as capital, as you see on this chart of gold versus our money supply, it simply holds its ground. And in 5 years, who knows what will happen in 5 years? But I know this. I know gold will hold its ground. I know people will be able to sell it. There's always a market for gold. They'll have access. They'll have value, and that gives them options. Whereas depending upon what is coming, and who knows what's coming, you may or may not have access. You may or may not hold value. You may or may not have options. But gold is timeless.
That's right. There was an example this week that I didn't even share with you guys, but a family who's owned gold for a long time had an opportunity to buy a legacy property, like a one-of-a-kind, can't recreate this type of property. You're not going to have another opportunity to buy this type of property in this location. Location's everything with real estate. And this individual truly believes gold is going to the moon and owns a lot of it and knows that it's a bad time to sell gold. Well, he had an opportunity to be productive with some of the capital. So what did he do? Sold a chunk of gold. It was capital. He got liquid within a day. And here he is off doing something that he considers productive. Of course, they still own a good chunk of gold. That is capital. He's using that capital, turning it into something productive. And so there's an opportunity there for him to do that. He knows that he's selling probably near the bottom of gold. He knows that. But he's going to go do something productive, but he still maintains this other chunk in gold. And he clearly stated, I'm going to be coming back around after I do this productive thing with my capital, meaning he took gold, liquidated, putting it to work. He's going to come back around and buy it again. He didn't even really care what the price was going to be. He knows he's going to be paying higher price for gold in 2 or 3 years, probably a much higher price. But that's a great example of the capital, that it's a store of value and you can turn it into something productive when you want, when there's opportunity. I think gold's headed higher, so did he, but he had something to do with it. So he was using that capital as a store of value. I mean, I think they'd hold on to this stuff for 20 years. So he was turning it into something productive.
Let me restate this so I can hear it in my own head. So we're saying that liquid capital provides access to opportunity.
Indeed.
What a shocking surprise.
Yeah.
I actually love that concept, and it's an important part of any portfolio. I think one of the great frustrations for me growing up, because I'm now in my early 40s, so growing up through an exclusively inflationary time period, one of the great frustrations for me is that we have been fed this concept that growth is the sole motivator for a financial portfolio.
It's all about price action.
It's all about price action, and it's all about growth price action, and it's all about your financial advisor encouraging you to put 90+% of your assets into growth vehicles. The whole time you were talking there, we were looking at the comparison between gold and the Dow, gold and the M2 money supply, and the purpose that gold holds in a portfolio. I kept hearing the words of the late, great Harry Brown talking about his permanent portfolio concept going back to the 70s, which some of you guys that have been here, yourself and Kevin on the weekly commentary for our listeners that also catch the podcast, 30 years ago, you took Harry Brown's concept and you simplified it even further into what we call the financial triangle. Now, the idea behind this is you have money that's meant for preservation against concerns of the currency or inflation or government. You have money that's meant for spending, capital availability, liquidity, and you have money that's meant for the sake of growth and income. And to have a portfolio divided up in which you're allowing each of these pieces to serve their own purpose, it allows you to say, be more aggressive with your investment assets because you know you've got the safety net of things like dirt and gold on the flip side that can't ever go to zero. So I'm glad you brought that up. What scares me about that is all three of us being in the gold industry is over the last 20 years, the asset that's never supposed to change price has done twice as well as the asset that's exclusively meant to gain. And that's the part that frightens me.
So define that for our listeners.
So gold being up, what was the number again over 20 years? 500 and what?
50%.
552.
And the Dow is up how much in the same time period?
267.
So the thing that's meant to grow is done half as well as the thing that's meant to not grow.
Yeah, your insurance policy performed better than your growth vehicle.
That's scary.
Well, and it depends on when you start the clock.
Right.
And this is what's so difficult when I speak with financial advisors and stockbrokers, because like you said, Miles, their view of investments is solely growth oriented. That's all they're interested in. We are on the other side of that. We're capital preservation oriented. And when your preservation portfolio outperforms your growth portfolio, depending on where you start the clock, sometimes it's the other way, like we've seen over the last 10 years. But there is a good reason for that. We have seen on that chart, if you go back to 2011, you will see gold radically overvalued versus M2 money supply, just like it was in 79-80. We're not there now.
So I want to see if maybe you'd amend something in there or part of a sentence in there you just said that had me thinking, and that's the financial advisor is solely focused on growth. And I don't know if I'd agree with that, because I think financial advisors are focused on a roundabout portfolio. I would argue that they're using a single tool to try to accomplish different aspects of a portfolio.
Okay.
And I think that's why we've created things like mutual funds.
Right.
Where the whole idea is
annuities.
risk mitigation. Well, you should be mitigating your risk in risk mitigation assets, and you should be growing in growth-oriented assets. So I don't think it's that complicated. I don't think building a healthy financial portfolio is that complicated, as long as you let your left hand be your left hand and your right hand be your right hand, and you don't try to mix the two. And I think that's where the problem comes.
Yeah, thanks for changing that, because you're right. I mean, they're looking at income, they're looking at taxing and tax issues, and they're looking at growth, and they are trying to accomplish everything in both the debt and equity markets.
And yet, no matter who you are and how the investment portfolio looks, somehow it always lands on 60% stocks, 40% bonds.
Yep. The biggest problem they have is they are myopic in terms of what to them the system is just fine. Things can be mitigated or seen in advance, and they'll always have the ability to reallocate
Right.
when the time comes.
So everyone's bought into Ben Bernanke's PhD thesis. I mean, we're all living in a world where we can see if he was right or not. Like 50 years from now, we'll be able to look back and say, can you manage your way into eternal growth? So we don't know. We could be wrong. Maybe the three of us are wrong. Yeah. Maybe you can inflate your way out of every problem. It's never worked before, but maybe they figured it out this time.
This time might be different.
This time might be different.
Yeah, this time I think I'm just going to continue to stack ounces.
Well, you can't go to zero that way.
Yeah, and if you go back to this M2 money supply versus gold chart and look at when have you had the opportunity to buy gold below the money supply line, there was only a really decently significant amount of time that you could have done that between 98 and 2007 or so. If you look at since that 2007, 2008, it's been well above it and only a little bit below. And right now it's actually a little bit below the line. So good time to be buying if you're looking at this M2 money supply versus gold chart. And if you look at where it kind of changed from being a long-term period below it, it was at that 2008, 2009 timeframe. And what happened then, what changed is you started having bailouts, just money just created out of nowhere. So the money supply started just skyrocketing, and it just gets flattened out over time on this chart. And we'll see the change in the trend has clearly been made. And since then, it's just been continually changing the trajectory of that M2 money supply line. And now, if you look at this chart, it just starts going straight up almost. And so here we are with gold, soft, actually, relative to the creation of money and the money supply. And if this money supply continues this same angled direction, gold is going to take off and follow it and going to probably lead it. So I like this time period. If you're looking at this chart, this is the time to be buying gold because it's below the M2 money supply line in comparison.
Yeah, I think that's the market cycle discussion that we were having earlier. So we looked at 10-year and 20-year. Rob, I know you wrote this down too. Let's look at the 5-6 year. When gold hit its floor back at the end of 2015, how far is gold up since then?
Gold's up 54%, and the Dow Jones Industrial Average is up 80%.
Okay,
That's in 5 years.
That's over the last 5-6 years, right? So the Dow is still beating gold. as it should be. An investment portfolio, when investments are rising, the investment portfolio should be outperforming the safety hedge, obviously. But what's interesting about that to me is we're looking at the end of a 10 or 12 year, or I don't want to say at the end because we're not market timers, so forgive me, but we're looking at by a number of measures what could be nearing the end of a 10, 15-year market cycle in the Dow. PE ratio, price movements, price action, how things are moving, where the money's coming from, our concern over the manipulation in the market and the amount of printed dollars going in, corporate buybacks, something David and Kevin have been talking a lot about. So there's a lot of reasons to argue that the growth in the Dow is not natural. And we're nearing the end of that down market cycle compared to gold, which just started its next major market cycle a few years ago, up 55%, up over 90% if you take low to high, the peak we hit back in 2020, but we are having that very shallow pullback right now. So yes, as Robert was saying, you may look at the gold price and say, man, what if I had gotten in 5 years ago at $1,250?
And is it going to come back down to that?
Right. But what if you're also
so.
still in, say, the first leg of a 3-leg phase that may last 10 years, like the last time? There's your M2 supply chart you just pulled up. When was the best time to buy gold in the last 20 years? 1999 to 2003. When did that market top out? 2011. 10, 12-year market cycle right there. Sounds like we may be starting another one.
Yeah, and we could get really into the minutia of this, but if you look at this M2 money supply chart versus gold again, and as Rob pointed out in 2011, gold price was way above money supply. Then it came back down and touched the money supply, and then it came just below it. Well, that low below the money supply line actually corresponds with the bottom of gold at the end of 2015. So a touch below the money supply line for the gold price corresponded to the low in the gold price. And then it popped back above it, and then it came back down again below it. I think that low is somewhere in the 2018 to 19 timeframe. That corresponded with another low in the gold price before we've had this significant move higher. So now we're actually, again, we went back up, we're actually below it again. I'm going to argue, guys, that's going to be a low for gold. Maybe it takes another leg down from here, but I don't think you have but maybe a week or two for it to do that. So I think a week or two out before we see gold start to catch back up to money supply and probably take a big rally from here.
I think so too. And one of the things that I do point out to people looking at the futures price, the contract price of gold, spot price, is no indication of the demand that we are seeing. Art, the demand for physical gold is huge right now. And what we see, the lackluster performance in the futures market called spot, is not an indication of the volume of business that we are seeing. People are buying physical gold to one of the greatest levels I've seen in the 35 years since I've been here.
And I'd add on to that, we're dealing with people who are thinking for themselves. So the masses have not turned on to this yet. So we're dealing with a forward-thinking client for the most part. And so we're seeing that demand from the forward-thinking client, the market participant, so to say. Maybe that's the second phase of a bull market. And so we have not even yet to touch into the public coming to our market.
Right, and that's the panic.
That is, and that is what drives gold to ridiculous prices in the next 5 years.
That's the panic, and I totally agree. We have not seen the panic.
Right. We're dealing with forward-thinking people who are accumulating ahead of this next move higher in the next few years.
Right.
That's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by, and Rob especially appreciate you stopping by this week. So
anytime,
thanks for joining us.
Thanks for having me.
If you liked what you heard, hit the subscribe button, ring the bell. You can find more info on Twitter at ICA Gold. We're also on Facebook at McIlvaney Financial, or swing by our website at McIlvaney.com. And as always, if you'd like to talk to any of the advisors here at McIlvaney ICA, we can be reached at 800-525-9556. Thanks for listening. Have a great week.